Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike, and best of the season.
Oh, thank you. It's great to talk with you.
Well, as we're wrapping up the year, the market's set so many record highs in 2021. Can we expect to see the same in 2022?
Well, we're wrapping up the last couple of days of the year, and this is the time in which all the Wall Street experts and analysts put out their predictions for what's to happen in the next year. I think the best way to try to figure out what's going to happen is to simply look at what's already happening. Because typically in the markets, the trend that you're seeing continues until it's, ends. And what has been happening this year is that, yes, the S&P 500 has gone up, but we're seeing a divergence inside the stock market with the stocks that are leading the market and the stocks that are lagging the market, which I think is a huge trend that does have ramifications for next year. So in a bearish sense, and then I'll talk about some of the bullish factors or where the best things to buy look like they are, but a bearish development is that the number of stocks above their 200-day moving average inside the U.S. stock market peaked out in the first quarter, and many stocks are below the 200-day moving average and are already in what are essentially bear markets, even though the S&P 500 just made a new high as we're speaking. There's just this wide divergence, and a lot of the stocks that are doing bad are stocks that were hugely popular last year. Many of them make up the top 100 list on Robinhood. Many of them are things such as the ARK ETF, invest in. So just to give you an idea, if you want to break it down into some individual stocks, what's going on, I just ran a scan before speaking with you, and if you look at just the S&P 500, since the beginning of November till now, basically the past 2 months, the top performing stock is Qualcomm, up 32%, Micron up 29%, Pfizer 28%, Dollar Tree's in the 20%, Apple's up 18%, Advanced Micro 16%. Apple alone heavily weights, just by itself, it's helping to push the S&P 500 up. In Micron, in Advanced Micro, they're helping to fuel a broader rally in the semiconductor index. Now, if you flip it around to what's doing the worst, the list of stocks on the bottom is Penn National down 32%, Moderna is down 30%, then you got Dish Network, Under Armour, Twitter, Norwegian Cruise Line, PayPal, Caesars Entertainment, Southwest Airlines. The thing about these stocks I just listed, all but one of them are among the top 100 most owned stocks among Robinhood people. So in the very beginning of this year, we saw this rally in GameStop, AMC, and all this talk about how this is the small person on Robinhood, they can squeeze stocks. They can just use the app and buy what other people in the app are doing and make a killing, or get on a message board and just, do all this together. That all turned into a myth. And I think that's going to continue to be a story next year, that these stocks that were so popular last year and going into January, they peaked. They're now doing terrible. They're in bear markets. I see no reason to think the bear markets and those stocks are going to end. And that means eventually next year we're going to really see a shakeout among people that primarily use Robinhood and this type of herd investing. I think that's one of the things that's going to happen. At the same time, I do think we're going to see some select sectors continue to do well. The stock market averages, we haven't really seen all year a meaningful correction when it comes to S&P 500. Not once has it fallen more than 10%. The NASDAQ did in March. And I think we're due then for some sort of at least a correction, maybe something even bigger than 10% for the S&P 500. But if there's any dip in the stock market, it's going to smash these stocks that are lagging. And I'm really worried, frankly, about people who, invest in things such as the ARK ETF, which, as we're speaking today, is down for the year. It's trading at the moment at $95. It opened the year around $125, so it's down. Meanwhile, if I want to single out a sector that two sectors I really like. One is energy, because I think we're still in what is the early part of a new commodity bull market. One thing that happened this year is, we started the year with the Federal Reserve saying, look, inflation's going to come, but it's going to go away. That prediction failed, and now everyone is accepting that inflation is real. And now the Federal Reserve is saying it's not going to go away next year. They're projecting, it may just dip a little bit from the elevated level they think it's at now, but they're not predicting it to stop. So I think commodity-related stocks, energy, mining stocks are going to be a good place to invest. And similarly related to that is RWR. That's an ETF I own, which tracks REITs. It owns real estate investment trusts, which are good proxies for real estate. And that ETF opened the year at 85. It's at 120. So it's basically done the reverse of the ARK ETF. So if someone wanted to do a pair trade where you go long something and then short something else to reduce your risks, I would go long RWR and short the ARK ETF. Bet that real estate prices are going to continue and these fad stocks are going to continue to decline. And when it comes to real estate prices went up as of the end of October over 18% in the United States. 20 cities posted double-digit annual returns. And in real estate is something that tends to go up when you have inflation, and I think it's going to continue to do that in the years to come. And I think, if I had to say what's one good investment for people to make, it would be real estate.
We'll have more with Mike Swanson right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, with the push towards electric vehicles, sometimes mandated by governments, they won't be offering, for example, ICE engines after 2035, or you won't be allowed to buy them. What kind of supply of battery metals do we have? Do we have enough out there for this anticipated total switchover? Can it actually happen?
Well, I mean, there's a shortage of the metals as you are suggesting. As to invest in that, I would completely avoid, what people think is the obvious, and that's buying Tesla or a couple of these other high-flying electric vehicle stocks because they're so overvalued. And look, Elon Musk has been selling the stock himself, billions of dollars worth, over $10 billion. He's sold more shares, the value of the shares, than the company makes the net revenue. That's, how much he's unloading now. And then you got another stock that IPO'd in November, Rivian Automotive, that hit 180 and now it's trading at 101, and it doesn't have any revenue. And so over the past couple of years, what has happened is a bubble has developed in the electric vehicle sector in the U.S. stock market, and I think it's therefore one to avoid. If you want to try to bet, though, on the shortage of metals, therefore the way to do it is to do it in the stocks that are mining these metals or exploring for these metals directly, and not in the automotive vehicle companies. I'm not an expert, though, on which those stocks, in that sector are the best ones to buy. So, people would have to do their own digging and research, and I'm sure you got guests that are much more expert on that than I am.
Well, take a look at the start of the gasoline-powered automobile. There were literally thousands of companies that made them, and now there are, 20 across the planet?
Yeah, exactly. And General Motors itself, I mean, the name General Motors, what it was a company that bought out all these other little companies and made a combination out of them.
Right. Again, Buick and Cadillac, all those companies merged together to make just one big company. And even now they say General Electric offers too many models to really be the most efficient company. Too many similar models.
Oh, for sure. And it's going to be interesting, though, what happens with Tesla going forward here. I mean, there have been lots of people over the years that have tried to short Tesla, and obviously they failed or lost money doing that. And meanwhile, it's a company of controversy, a CEO of controversy, and they're competing against Ford, GM, and so forth. So it's going to be an interesting story to watch unfold.
Now, on the energy front, though, before electric vehicles take over, if they ever do, we have so many institutional investors now getting rid of their oil and gas exploration investments. And I'm hearing from so many people, this could lead to a shortage of oil for fuel purposes for our vehicles. And don't be surprised if oil hits $100, $200 a barrel. What's your thought there? And, of course, the corresponding increase at the gasoline pump.
Well, I think they're correct. I think there's a lot of reasons for oil prices to go up. One, as you cite, there has been a lack of drilling and exploration in oil over the past couple of years. I mean, the industry reached a peak in 2014, and then there was a oil bear market that, caused many companies to go bankrupt and a big pullback or reduction in the budgets of exploration and drilling for oil. And then last year, when the stock market had its crash in the spring, many of these, energy stocks crashed too, but they bounced back up. And this year, they're doing pretty good against the broad market and much better than, these fad technology stocks. So for example, I don't own it, but Transocean, symbol RIG, it fell below 75 cents a year ago, and now it's trading at $3, and it's, been in a range of $3 and about $5 since February. So that's a stock that could break out next year and do well. But and then of course there's bigger oil companies that that's where I have most of my money invested in the space. For example, I own Exxon, and you can get big dividends in these type of stocks, and all this talk that oil is going to be replaced or something. It's going to be a long time before that happens, if ever, in my opinion.
Well, I guess we'll have to return to wind-powered ships. Mike, thank you so much for chatting with us.
Thank you. Great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@HowStreet.com, and we'll ask that question for you. Our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.